Hello, this is Scott Jackson of Jackson Private Wealth Management, a registered investment advisor here in the state of Florida. There's a lot of talk in the financial press these days about inflation and whether or not it will prove to be transitory. So why is that such a big deal? Well, inflation does have a significant impact on both sides of the investment spectrum, both stock and bonds. Bonds, of course, are paying a fixed rate of return that investors hope will enable them to keep relative pace with inflation. So if inflation were to rise significantly, then the current rates being paid by governments and corporations might prove to be inadequate. And so what might bond investors do? Well, bond investors might demand more before they would invest in new issues. And that, of course, could be detrimental to both governments and corporations. What it would also impact quite significantly would be the so-called equity risk premium. Now, investors in the stock market generally do use the bond market as a gauge of what they're going to receive relative to what they could get from a fixed bond. Why? Well, the bond pays a fixed rate of return, and assuming it's from a high-quality issuer, there is a guarantee of principal repayment. So a bond is generally considered safer because of that repayment of principal, and because, of course, they're higher in the credit structure from a corporate standpoint. But now, let's say that the U.S. stock market right now is relatively fairly priced versus bond yields. And that may seem like we're going out on a limb with that statement, because the U.S. currently, when you look at the amount investors are paying relative to average 10-year earnings, we're actually at the second highest level that we've ever been. So we are definitely in unique territory. That being said, we are at all-time bond yield lows. And so relative to those low bond yields, if we were to take what investors are paying and get some sense of the risk premium, Robert Shiller recently used the expression excess CAPE yield. Now, the CAPE is that measurement of what investors are paying for 10-year average earnings. It's also commonly referred to as the Shiller PE because he helped make that quite prolific in the financial world. And so what he did a few months back was he said, why don't we, instead of just looking at what investors are paying for an average 10-year earnings, let's look at the inverse of that, because that's how long it would take an investor to break even. So back when he did this in December, for every $1 in average 10-year earnings, investors were paying roughly $33. So if you were to divide 1 by 33, it would imply that it would take you roughly about 3% per year for 33 years, simple interest, to get your money back. So that is essentially the equity yield, if you will. Granted, it's not fixed, and it very well may fluctuate quite dramatically over time. But for that moment in time, 3%. And then if you were to look at the 10-year Treasury real yield, looking at where it currently was at that time, and then subtracting the average inflation rate over the last 10 years, it actually brought you to a -1 real yield. So if you were to subtract the -1 from the 3% equity premium, or the equity yield, you would get an excess CAPE yield or a premium of about 4%. Now, all of that is of interest because let's say that investors, while maybe not having it calculated out precisely, but let's say because the reason this was being shared by Dr. Shiller was trying to make an argument for why equities might be reasonably priced right now when you do take bond yields into consideration. So let's say that that is true. Let's say that investors have a pretty good sense of what they're paying relative to the real yield in bonds. But let's say now that instead of -1, let's say that bumps up back up to even. And the equity investor is still hoping to have a premium of 4. Now, if that's the case, that would imply that the CAPE or the Shiller PE would need to come down from 33 to 1 down to 25 to 1. Let's say that the bond yield then bumps up another 1 from 0 to real yield of 1. And the equity investor wants to stay in that ballpark of 4 on the excess CAPE yield. So now, where would he need to be? Well, he would need to be somewhere around a 20 to 1 Shiller PE. So that implies some pretty dramatic downturns in the stock market if investors do want to keep that ratio of 4. So we do have some significant concerns because obviously the bond market could reverse course pretty quickly if inflation were to take root and stay. On the other hand, a number of very thoughtful economic minds, David Rosenberg among them, another favorite of ours, believes that it is likely to be transitory and that the near future we will see supply catch up and equalize again with demand and might even exceed demand in the not too distant future. I noticed yesterday that Jerome Powell in his comments noted that we would need to keep an eye on the supply chain because obviously there may prove to be some bottlenecks there that may not open up as quickly as we would hope. And if that were the case, then inflation could prove to be a little more long-lasting. So there's a lot to get your mind around here. I realize that. If you have questions and you'd like to bounce an idea or two off of us, feel free. It is a complicated world. We can help. Best wishes.